Treasury yields remain stubbornly low as 10-year yields remain at the 1-year and year-to-date lows, right? Just basically trading back and forth below 260, just above 260. We're kind of straddling that, sitting precariously, waiting for the next catalyst event. And we have some events this week that could push us one way or the other, but ultimately it looks like we're here for at least a little while longer at the low end of the range. We've made a few attempts to get back to 270 and failed. So the market right now holding at the lower end of the yield range for the year. And like I said, you got to go back to Jan of 18. Last time we saw this type of trade sustain this level for this long. And ultimately, I think right now demand, maybe perhaps a flight to quality bid from, say, European banks, or you've obviously got a lot resting on China and what's happening there. But from a technical perspective, it seems that the market seems very buyer friendly, despite the fact that yields are so low. And we're seeing it not only in the 10-year, but obviously you're seeing it also in the 30-year. So the back end of the curve remains very well bid in Treasury land. And if you look at market volatility ahead of key events like FOMC, Bank of England, we've got a Brexit event coming in 10 days. We've got a lot of what ifs out there. China and trade still is uncertain. You've got some talk of geopolitical issues going on in Korea again, and you've got the Middle East as always, and volatility remains on the year-to-date lows and trending lower, likely to make new year-to-date lows ahead of FOMC, which is a bit of a surprise. Typically, market sees volatility bid with the uncertainty, but at this point, it seems that there isn't much uncertainty, but volatility remains very low despite the fact that we are on the precipice of breaking out of the range. Now, we haven't done it yet for any sustained period. We've dipped below that 260 line in yields, but we haven't been able to see a trade sustain through it. I think we need to see a trade towards 250 in yield. If we get below that, that may cause volatility to spike, but right now there is just no concern, no fear, no trepidation, nothing that the market is going to see a massive move outside of this 260 to 280 range. We've been holding it for so long. I think ultimately it's expecting a reversal back up to the mean after some of the dust settles, after some of these global events. But right now we haven't seen that, and the clarity is still very blurry as to where we go. And if you want to talk about what's happening this week here, the FOMC meeting is obviously taking front and center stage. There are several other central bank meetings, including the Bank of England. Their last chance to talk about Brexit before the March 29th deadline. But our Fed here, they're not going to be changing rates. And right now, the Fed fund futures are not seeing any kind of a rate hike for the foreseeable future, possibly a rate cut if we look out into 2020. But right now, I think we're going to stay in the here and now. And what the market really wants is clarity on the outlook of the economy. We've seen a slew of weak numbers, factory orders. We saw manufacturing, housing is a question mark. Likewise, credit continues to explode. And I think that if the Fed gives us some kind of a realistic outlook via their dots of where rates are going to go, or about the economy itself and growth, that could help. It will probably mean that yields will remain stubbornly low, though, because I don't see a whole lot of glass half full type of news other than employment. Likewise, the market wants clarity on its balance sheet, and it's how it's going to continue to work the balance sheet. Is it going to continue to see it decline, or are they going to maybe find a new elevated home that they'll tell the market this is where it's going to be? Used to be at $1 trillion or just below. Now it's going to be at, say, $3.5 to $4 trillion, and that's just the way it is. I think that there's some clarity that is needed there. I don't know if we'll get that this week. However, market definitely wants it, but I think ultimately yields will remain low at least till the end of March, so we get past Brexit. Likewise, China trade deal continues to scratch heads, and why haven't we gotten something done yet? So there's a lot of uncertainty in deals, whether it be from the UK and the US. How we move forward as a global economy, again, will bleed into all this, and that's possibly one of the reasons why we're seeing Treasury yields remain so low, given the fact that while there's speculation that some of this buying is not coming from Asia, I think some of this buying is coming from Europe with the risks of their economy. So growth remains suspect in the first quarter. The Fed could change that with a little bit of a rosy outlook, but I don't know if the market will believe it, even if they tell us keep watching stocks, because the lower yields go, the higher stocks go, because that's where you lose out on the yield to stock comparison. If you can't get your money in yield, you're going to go get it in growth in the stock market, and that seems to be working until it doesn't. But right now, Treasury yields remain stubbornly low ahead of the Fed meeting.